Well, if you've watched my social media for very long, you know that Dave Ramsey, that's all he talks about is like permanent insurance sucks. If you use it, you're an idiot. You're stupid with his, overinflected at the end of the day, man, there's something for everybody. And we always say it depends. Like I know that's the most overused phrase that we use is it depends. But kind of wanted to go into just permanent insurance in general. We won't go outside of like in the variable world and everything. Just the two hot topics are IUL versus whole life. IUL is indexed universal life. Whole life is whole life. It's a permanent policy. It's a little more expensive. It has guarantees in it. But we're just going to kind of dig into it a little bit deeper. So I'll let Fish go into it. Kind of what you've been on both sides of the fence pretty heavy. Whole life, I know how it works. I know how the loans work. I know how to structure them. But just kind of give me an overall your view, which is the view, because we're not going to give you fake information on whole life versus an IUL.
Yeah, I mean, whole life, essentially, you said it, it's guarantees. The good things about whole life is originally a lot of people use it for a bond replacement because it does have the contractual guarantees in there of 3.2. If you subtract out the dividends, it has what's called a non-forfeiture rate. All that means is that if you don't ever get dividends credit to the policy, you will get a guaranteed interest rate on top in the cash value plus your premiums that you put in. So that's kind of just whole life is I want you to think of guarantees because it is guaranteed, it is expensive. Guarantees are always expensive. That's not a bad thing. It's just if someone prefers that route and is super conservative, you can go there. The difference on the IUL side is you don't really have a guarantee. You have a 0% floor or 0.25, or some carriers have one or two now, like they all market it differently. But you have basically 0% floor. But because you have no guarantee, you have more upside, right? So it's just a different risk tolerance on the continuum. If you have whole life here, IUL would be a little bit more risky, even though I don't want to call it risky. And then the variable universal life or the VUL is the most risky. So just depends where on the risk continuum you fall. Whole life's the most conservative, then IUL is right in the middle. It's kind of a mixture of both. And then the VUL is the farthest to the right hand side, which comes with its pros and cons as well too. So that's the biggest thing that I see is how the interest is credited to the account. And we can talk about that a little bit more. But one of the funny things that I do find on whole lives is a lot of people make it out to be that nothing is ever going to change inside the policy ever. It's just what you see is what you get, which is pretty true because it will be very accurate in terms of the illustration. But there are two pieces to the policy that most people don't realize. You have your guaranteed interest of 3 point whatever percent that the carrier does, plus a dividend that is non-guaranteed. But everyone who's a whole life proponent, again, I love whole life, I love IUL, I love both. But everyone will always say that the dividends are not guaranteed, but they have paid out 170 years of the 170 years the company's been around, right? But what they don't tell you is that the dividend does change pretty drastically, just like the caps do on an IUL. They can fluctuate because as interest rates go down, the general accounts of the companies are less profitable and they start changing a little bit of the dividends. Again, it's not good or bad, but I don't like when one side of the story is told and the other isn't. So just know that whole life dividend plus the guaranteed interest, you're usually going to get net of fees and everything like that. You're probably going to get 3.5, maybe 4%. But that's usually where you're going to live in terms of the interest and the dividend. It's, again, nothing crazy. All those dividends do change as well too. Don't let anyone lead you to believe that it's just guaranteed for life. It's going to be that dividend. It will change as interest rates change.
Real quick, you said two things, and I'm going back pretty far. Bond replacement. Can you just talk what a bond replacement is and why it's important?
Yeah. So there's a lot of financial studies done on this. We won't go into that, but if you want to look at where whole life can be really helpful, is you take out the bonds in a portfolio. Most people have a target date fund in their portfolio that's a blend of equities, it's a blend of bonds as well too, and it gets more bond focused as they get older. But a lot of studies have been done. If you want to just take out the bonds in your portfolio and put whole life in, it's actually pretty cool because you have a guaranteed rate of return. Plus, you actually get insurance along with it, where if you were to go get term insurance or permanent insurance somewhere else, you would have to factor that cost of the insurance plus how much you're putting into bonds. And it actually is more efficient to just use a whole life. And that's actually what that UI study used, was the Ernst & Young study. They use whole life because you get the death benefit and you get permanent insurance and the guaranteed rate of return in that portfolio for a certain amount of premium versus if you were to do bonds plus term insurance or term insurance somewhere else, you would have to subtract the term insurance costs out, and that would eliminate your bond. That would minimize your bond budget as well too. So that's, hope that answered the question, but that's usually what we see when people talk about a bond alternative in the portfolio.
Gotcha. Yeah, I'll talk about it in caveman terms. If you don't understand that, a bond is basically going to be your safer quote unquote investment, and your equities are going to be your higher return. So an equity is basically just talk about something in the stock market, like an Apple stock or S&P 500. It's something that's going to give you more upside, but possibly a lot more downside versus bonds. It's more government focused, so there's more quote unquote guaranteed returns. But right now, we see bonds are actually getting out of hand to the point where bonds may even go away, to where cash value life insurance may completely replace that. And then one more thing, I think we always talk about caps and floors, and we just hope everyone understands what we're talking about. What's a cap and what's a floor, and why is it important with cash value life insurance, and how does it make it different from whole life?
Yep. So there's the death benefit side of it, which we both know, and then the cash value side of it grows with those different strategies that we mentioned. Interest, dividend is whole life. Cap and a floor just means that the cap is how much you can gain, the maximum you can gain in an IUL chassis per year. And then the floor is you can never go below that in terms of interest crediting per year. So a lot of people say that you will never lose money in an IUL. That's actually not true. You won't lose money due to market losses, but you can lose money due to fees, cost of insurance, and things of that nature. So to reiterate it, the cap or the participation rate, there's different strategies that use that term. That's the most you can gain per year. And then the floor is basically the minimum you will ever gain, and you won't go below that per year.
Right. So like an SP 500 goes down 20 points, you would get a zero credit. But if the S&P went up 20 points the next year, you might get capped at a 9, 10, 11, 12, whatever your carrier's allowing you. Kind of said it the other day, the bumpers analogy. Whenever you're bowling, you put the bumpers on, you have a 0% cap on the left, or 0% floor on the left, and a 12% cap on the right. You can never escape those bumpers. But it's not going to hit home runs. Like if you see someone on social media say 14% average rate of return, or in retirement, if you have 400,000 in your IUL, you could get $50,000 a year of income. They are just basically using carriers that have no cap integrity. They have crazy volatility control indexes, and most likely they're B, B minus, even C plus rated carriers. And then real quick, go ahead.
I was gonna say on that too, one thing that really I enjoy is people posting their IUL performances. IULs do 100% perform, but I always want to say compared to what? So just to give you context, what did the market do this last year? Like, let's look it up quickly. I think it was, I don't know, 30%.
Yeah, last time I looked it was 23, but that was months ago.
So year to date, the market did 21%, meaning the S&P 500. In the past year, it did 34%. So it kind of makes me laugh when people are like, look at how great my IUL did. And they're like, oh, it's 7%. But if you draw compared to what, the market did 32%. So you always want to ask yourself compared to what when people are showing illustrations, because again, it might be 31% and 32% this year, and we might have 30% down next year. So it's not that either is good or bad. You just want to make sure understanding the context of what did the market do compared to the IUL and vice versa.
Right, right. I'll kind of tie these two together. So within an IUL, you have your returns based on options. Within whole life, you basically have a general account portfolio plus the dividends, or how profitable the company is, or return of premium. So let's talk about those two right quick, and then what you should expect to have in return from whole life versus an IUL.
Yeah, to touch on that too, the death benefit, we didn't really cover the cost and the death benefit on IUL versus whole life. Whole life, usually the way people describe it, because if you look at a ledger, you will never be able to find the cost of a whole life. You could do the math and be like, hey, I'm putting in this much. There's this much in the cash value now after what I put in. You could do the math there and say, hey, I put 18,000 in the first year, I only have $1,000 of cash value. The cost might have been 17 grand, but it's really hard to decipher that because no whole life policy will actually ever illustrate the cost of the policy. So it is hard to decipher that. The break even point in terms of a whole life, when you talk about just a base policy, is like 15 years out, which is pretty standard. It's not good or bad. But the reason I say that is because on the death benefit and cost of the whole life, you're prepaying almost all the cost of insurance up front to get ahead of it, because you can't outgrow the cost of insurance in an IUL because your policy is growing at 6-7%, and the cost of insurance is growing a little bit over time, but you're at least ahead of it. So whole life, you prepay it up front, which is why you have a lot of those zeros if you do a base whole life. And then an IUL, you basically just pay for whatever the risk is that year in an annual renewable term. So it's very cheap at the beginning. And if you don't structure it right, the cost can get very out of hand. But if you do structure it, it actually gets cheaper the older you get, which is what a lot of people don't realize. So just wanted to touch on that quick before we go in on to the other topic.
Yep. And if you need visuals, let's just say a whole life is going to be a flat plane. So you put in, like you said, $1,800 or $18,000 a year. Cost of insurance is $17,000. That cost of insurance will stay flat permanently. Within an IUL, it's really like a bell curve. If you don't know what a bell curve is, just think of it like a swollen pimple. Starts out low, comes up to the top, kind of peaks, and then it goes back down. Why does it do that? Because your cost of insurance is not actually getting cheaper when you get older, but your gap between your insurance and your cash value, your all-in cash value, is getting smaller. Plus, all your fees have dropped off. Companies made their money; they made their profit. From there, your fees drop to like 0.02%. So
Yeah.
over a lifetime, you'll always hear, hey, fees in an IUL are huge. They are. The first 10 years, they're pretty out of hand, anywhere from 5 to 10% if you put cost of insurance, everything in there. But over a lifetime, you're talking about 50 basis points, a 0.5%, which if you go, back to the other podcast, we talk about money management. There's some people charging 2 or 3%. So 3% to possibly lose money. So they charge you 3% to lose your money for you, or a 0.5% to never lose value, but you never lose value to the market, not in your policy. So touch on that real quick. You have a 0% floor and the market does not perform for 2 years. You had no interest credited those 2 years, and the fees had to come out, and the cost of insurance had to come out. So you may have a cash value of $500,000, and 2 years later, you may have a cash value of 490 because you had zero growth, but you had the fees and the cost of insurance come out.
Mm.
So yeah, on the real numbers, I'll kind of touch on it real quick because it really doesn't matter. Each carrier is different. They pull different levers to make their policies look better than the other. I would say conservatively, after fees, after everything, you could probably expect about a 7% rate of return in your IUL. And if we're talking whole life, say 5.5. Would you kind of agree with that?
Yeah, I mean, I would say you're usually going to be about a 2% difference between IUL and whole life. So if you're saying 7, might be 5, maybe sometimes a little bit less.
Right. And then over your lifetime, it doesn't sound like a lot, 2%. But 2% over a 40-year lifetime is an extra compound cycle, which could possibly double your income versus a whole life policy.
Mhm.
And then the biggest topic there is out there, I believe, and a lot of gurus make their money from this, infinite banking. Love infinite banking. There's a lot of myths out there. We talked to a client the other day that had this ridiculous just outlook on infinite banking. I could put $500,000 into my policy. I'm going to pull it right back out and pay my loan off. So I'm going to go get a loan for $500,000, put it in my policy, pull it back out and pay it. Why? Why would everyone not do that? Why would Elon Musk, every time he made a dollar, go put it in a whole life policy, borrow it back out, give it away? Real quick, since I'm on social media all the time, one phrase you always hear is you can borrow up to 90% of your account. They never say cash value of your account in year one or within 30 days. It's kind of true. It's wordplay. If I put $10,000 into my IBC whole life policy, it's more liquid. You'll have access to up to 90% of your cash value. So if I put in 10,000 and I have a high early cash value or a high cash value policy, I may have access to 8,500. You only want to access 90% of that. So $7,900. So a lot of people think I'll put in 10, pull out 9, $1,000 it got me cost of insurance. It's not the way it works. And you've been around this a lot too. Go ahead and hit on a couple times you've seen the IUL versus whole life infinite banking when it made sense. And honestly, I'm going to say it. Most people that I talk to don't need whole life infinite banking. They probably want the IUL infinite banking. Why? It's not really infinite banking. I'd call it banking on yourself. Infinite banking is put money in, pull it out, put money in, pull it out. Most people don't want to do that. I'd say 0.01% of people actually want to do that. Within an IUL, you have long-term growth. You have most of the time better loan rates depending on your carrier. And you have just overall, you have the retirement account, the infinite banking, the living benefits are just a little bit better in the IUL. So I'll go ahead and turn it over.
Yep. I'll say one thing quickly. Just the biggest misconception that I think we hear when we think of infinite banking is that you're paying yourself back the interest. It's not how it works. I literally just had a call yesterday, the guy that I text you about. He's an awesome dude from Texas. And he was thinking about it, and he rambled for like 5 minutes and just said, hey, this is what I think I heard, I understand. Doesn't really make sense because then you could just loop money infinitely and never pay any interest. I'm like, well, wouldn't you know? You're actually right. Like, let's talk about that. So real quick, infinite banking in a whole life, just so you guys know, like you said, if you put $10,000 in the beginning, there's a cost of insurance that we have to account for, which if the death benefit's low in a whole life, it is a low cost of insurance, which is fine. But the huge thing people don't realize is you have about a 6 to 10% charge for putting money into the PUA account. So let me ask you this. Why would you ever want to pay cost of insurance plus, let's say, another 8%, 6%, depending on the carrier? So about 10 to 15% of your money right off the bat. What bank charges you 15% to put your money in?
No, at least they give you 0.06%.
At least they give you money, right? So
Yeah.
I'm not a huge fan of infinite banking because there's a fat fee up front that most people don't realize. And then you have 90 or 85% access to whatever's left in there. So if you're going to put money in and pull it right back out, it's not hugely helpful unless you're saving up for borrowing that money in the next couple of years, in my personal opinion. And I'll show you the reason I think this, and I'll get eaten alive by probably a lot of social media people that do this. But again, this is just my personal opinion because I like other investments as well too. I don't only have insurance. We have real estate, brokerage accounts, trading. Like, you need to have a balanced portfolio. It's not everything goes into insurance and right back out to buy your life. So you think about it like this. You have money you put in, you have cost of insurance, you have the charges to go to the PUA cash account, and then you have a loan rate. When you pull money out, a whole life right now is about 8% to pull money out. It's not good or bad. I'm just telling you the facts. So you pull money out at 8%. If you don't repay back that loan, it's a terrible idea. Don't ever think that you can just pull money out and not pay it back if you're doing infinite banking. Infinite banking specifically says you need to pay back the money into the account. But here's the catch. A lot of people think that they're paying themselves the interest. You're just giving the insurance company your policy as collateral. And when I say your policy, I mean your cash account in your policy. And you take a loan from the insurance carrier at whatever interest rate. So you're paying them back the interest. You're not paying yourself the interest. So again, I just think there's a lot of misunderstandings about what infinite banking is. What I do think would be helpful is if someone's like, hey, I have a bunch of cash. It's sitting in the bank. I want to put it somewhere where it can at least grow in some interest. And in a couple of years, when it starts getting interest credited and dividends and things like that, then you want to have another asset to be able to borrow from that's not just languishing in the bank. That's where I like infinite banking, but I don't like it for put money in, borrow it out right away, start doing other things, do real estate. Like, let me ask you this. When in real estate have you ever had to pay back your down payment? Is that no one does that, right? So like, why would you ever, if you're not a huge multimillionaire who's using infinite banking, if you're just an average Joe who's like, hey, I have 100,000, I'm going to take out of my policy, put down for a down payment on a house, you need to pay back that down payment into the policy. So a lot of the econometrics just don't work, in my opinion, if you are a mid-level American. If you're a really, really wealthy investor, millions of dollars, yeah, it would work because you're just buying all these properties cash. You're not financing them. But that's the whole life side of it. Again, I'm just not a huge fan of it because it's a lot of fees up front. You have a really high loan rate, higher than an IUL, and the policy just doesn't grow as much as the IUL in the long run to be able to use it for what you're really wanting.
Right. Yeah, and real quick on the loans. So within a 401k, a lot of people say, "Hey, I pay back myself that interest within a 401k loan," and you're right. But let's say you have 100,000 in your 401k, you pull out 50,000, you pay that 50,000 back. You had 50,000 in your account because you pulled 50 out. It's a recognized loan. You have 100,000 in, you pull 50, there's 50 left. So you're earning interest in your account on the 50,000. You're paying back interest on the 50,000. So with cash value life insurance, there's recognized loans versus non-recognized, or direct versus non-direct. So real quick, can you hit on that? We'll move to IULs.
Yeah. Basically what it means is a direct recognition loan means that they are recognizing that the money came out of the cash account of the policy. So it subtracts it from earning interest or dividends. Technically, again, I'm not a whole life expert, But from what I remember, I believe that the money that you take out, if it's a direct recognition loan, does not receive dividends. It will receive interest still, but not dividends. Non-recognition basically means that they are giving you interest and dividends on the money that's loaned out.
Right. Yeah, I like to say it's like the 401k I just talked about. The recognized or the direct comes directly out of your value. Whatever's left over earns everything. Versus the non-direct is like, hey, you have 100,000. It's like a HELOC. Your house is worth 100 grand. We'll give you 50,000 of our money. So it's separate. Still earn the interest on this account, but you're paying on your HELOC. So that's probably the best way to think about that. So on the IUL, we both said we're more of a fan on the IUL infinite banking policy. Just kind of talk about why.
Yeah, and again, IUL, I will give you the caveat. IUL is not very good for infinite banking right off the bat because you have the surrender schedule compared to a whole life. A whole life does not have a surrender schedule, so you can access a lot higher values really quick if that is a priority. But again, I don't think that's a good asset to utilize for that. So the IUL, you do have less access in the beginning because you have a surrender schedule, which is a difference of access for a period of 5, 10, 15 years, 12 years with some carriers. But my point being is as long as you're fine using that money in a year, in 2 years, in 3 years, when you get more and more and more access to the money in the IUL, that's when you start to be able to benefit from having a good chunk of money to leverage out. But right off the bat, the surrender schedule and charges, depending on how it's designed, you won't be able to loan a huge amount out compared to the whole life, which is why the whole life is popular for infinite banking.
Got it. So on infinite banking, we'll kind of just squash that and say that's that. As far as like just overall planning for people's retirement, planning on just anything in general, we kind of lean towards the IUL just because the long-term growth, smaller fees up front. Yeah, you do have the surrender schedule. It's basically they're just going to make their money back if you cancel the policy in the first 10 or 15 years. But overall, how do you choose a carrier? Why do you choose a certain carrier? What makes one better than the other? Because there's a lot of people out there in these three-letter agencies that are pushing these two carriers that just came out with an IUL with a 3% floor and a 15% cap. Now, as soon as you hear that, Fish, I know you're like, what in the world? That's insane. 3% floor, fees got to be astronomical. They got to be doing something on the back end, or the caps are going to drop to like 6% soon. So, why do we choose the carriers we do?
It's goes back to, I think, strategy over product. Like we're never going to push a product because it pays the most or looks the best for us. You want to make sure that the strategy aligns with the person's scenario. So the things that we look for strategy wise to create the most financial certainty down the line for the client, because that's the whole point of using insurance, is more predictability, less deviation. We want to make sure that we have good cap integrity, and we also want to make sure that we have predictable loan rates or guaranteed loan rates in the future. So we want to make sure that we know what the policy is going to look like in terms of growth. We also want to know when we do want to access the money, what's it going to look like? Are they going to charge us 8%? Are they going to charge us 5%? Is there a contractual maximum, or are they going to charge us technically nothing with some carriers because there's wash privileges too? So those are the two. Is we want to make sure they have a good cap integrity, and we want to make sure they have favorable loan rates for when we're actually going to be needing that money.
Yep. There's one carrier, I won't say the name just because I don't want to get in trouble. They have an IUL. It's their old one, of course, but it's only, I'd say, about a year ago. They replaced it with a new IUL. They don't have non-recognized loans. So a lot of people, if you have this carrier and you don't know which carrier I'm talking about, I can't give hints. You can DM me or send me an email or something and ask. But that being said, one, the company is only used by an MLM company. They have a really good contract with them, so of course they just utilize them all the time. So one, you're always going to see a bad policy with them. Always. I've never seen a good policy with them. It's always level instead of increasing. It's always some flat death benefit instead of a random death benefit, which is what it should be. The guidelines are through the roof, meaning you can put in way more money than you originally planned to put in the money, which means the fees go through the roof. But a lot of people are using that for retirement. If let's just say you have $1 million in your account and you're going to take $80,000 per year, the sequence of risk return, like that sequence of return risk, that we have in 401ks and IRAs and stuff like that. Now you have that in your IUL. So why have the IUL if you're going to run out of money in 12 years? $80,000, 12 years. We have a couple years down, 4 out of 6, like usual. Probably run out of money in 12, 14 years. So you have to make sure there is some form of either non-direct loan, or a wash loan. So if you don't know what a wash loan is, Fisher, what's a wash loan?
Yep. So let's talk on the recognized loan quick for an IUL, because I don't know if we touched on that. When you have different carriers call it different things. It's like a variable loan, fixed participating, like they all have a participating or variable loan is typically what it's called, or an index loan. All that means is that, again, the money stays in the account. You're loaning from the insurance carrier, so it still keeps earning interest, and they just charge you a interest rate on that. So most carriers right now are like 5, right? It's like 5%. The ones we like to use have a contractual maximum. The reason I say that is because I used to have a policy where there was no contractual maximum. They could charge you 8%, 9%. And that's why I have a policy now where the maximum is 5, and it's going to stay that. So you don't have to worry about crazy loan charges in the future. So that's the first thing, is the recognized variable fixed participating loans, whatever they're called. You want to make sure they have a contractual maximum, usually about 5. And then the other type of loan is a fixed loan or a wash loan. It could also be considered depending on the privileges on it. All that means is that they're going to charge you a fixed interest rate, which is lower than the variable or participating. So I'll give you an example. The carrier that we use mostly right now is about a 2% fixed loan. But if you look at their contract, their loan language actually says that after 10 years into the policy, they will credit you 2 and they will charge you 2 for whatever money is loaned out. So what that means is they have to obviously charge you something because it's a loan that has to be interest charged, but they also credit you 2% on the money that's in that loan account. So that means that if they charge you 2 and credit you 2, it's a 0% wash, which means it's almost like taking a withdrawal out. So if we do have a couple down years, like Dustin said, in the market, we want to be able to utilize those different loans depending on where the market's at for the retirement planning side of it. So for loans, you need to make sure you have a guaranteed maximum on the variable or participating side. And then you also want to make sure you have a wash loan privilege after usually about 10 years into the contract.
Right. Whenever I first got into social media marketing, I would talk to certain gurus and say, my index loan rate right now is 2%. And they would just say, oh, that's impossible. It doesn't exist. And I'm like, hey, it's contractually guaranteed. It's at 2% right now. And we're earning, on average 9%. So you're actually gaining 7% on your loan. So you just imagine if you're in retirement and you're taking a 7% loan and earning 9, we're not saying that's actually going to happen. You make 2% on borrowed money. And as far as the wash loan, like you said, if we just know it's down times, like the last few years, we kind of knew the first 2 years of this, I won't even say it. So out of the last 4 years, we kind of knew 2 of those years were going to be bad. That's when you'd want to take the wash loan. Or if you're just like, hey, I don't even care. I don't want to look at the state of the world. I just want to go retire, go do the wash loan. So if you're looking to get an IUL policy, or you have an IUL policy and you're about to do an annual review, just basically means every 365 days, you meet up with your agent and make sure the policy is performing. Here's some questions you should probably ask, and I'll kind of tell you why. So one, what index am I in? A lot of people will put you into what's called a volatility control index, or a VCI, because it looks really sexy on the illustration. Like, hey, we average 9% or 50. If it's 2 years ago before AG 49, it could be a 14 or a 16% average, something just crazy that's never going to happen. So one, what index am I in? 2, increasing or level. So what type of death benefit option do I have? Is it B or A? Is it A, B, or C? Because it depends on the carrier, what they call it. If you're in option A, it means you wanted a lot of life insurance, or you were going to fund your policy less than 10 years. So if you go back and you have an option A on your illustration, or someone's presenting you an option A and you plan on funding it more than 10 years, run away. That's bad. You want increasing almost every time. If you're a high net worth client trying to just pump in as much money as possible, 5, 6, 7 years, you want option A. Fees are a little bit less. I won't get into it, but you want that option B. Number 2, what does your death benefit look like? If it's a solid $500,000, if it's $250,000, if it's $1 million exactly, that's a red flag. If you're trying to max fund a policy, and this goes into my next thing, you want a random death benefit. So if I'm putting in $300 a month, I want $256,321, some random number. Why? Because the IRS code says that if I'm going to put in so much money per my age, health, state, whatever, there has to be a certain death benefit tied to that. So if I put in $300 a month, to put in $300 a month, not a penny more, to max fund the policy, to make it work as good as it possibly can, I have to have this random death benefit. So that leads into the guideline. If you ask your agent, what's the guideline annual premium or the guideline level, and they don't know what that is, they can't find it, they'll say, hey, I'll come back to you and I'll get that for you. run for the hills. If they can't find it on the illustration, they're going to go ask their boss, and their boss is going to be like, hey, this guy asked me this question. I don't know what it is. Oh, here, let me rehearse it. Or I'll get on the call with you and I'll look at it for you. Your guideline level, if you're max funding a policy, so let's say I do $300 a month, should be about $3,600 and 1 penny. That means I can put in $3,600 per year and 1 penny extra. That is max funded. That is the least amount of fees, the most amount of growth that you can possibly get on that policy. Another thing is either going to be your minimum premium or your no lapse guaranteed premium. What does that mean? It means if I fall in hard times and my $300 a month is just something I can't do, I can reduce it to this no lapse guarantee premium or minimum no lapse guaranteed premium, whatever it's called. They should know this. They should be right next to the guideline level. So if they're looking for it and they can't find it, once again, run. They don't have no clue what they're doing. That should be somewhere around 10, and some carriers up to 40%. We have some carriers that when I max fund their policies, your minimum premium should be about $30 a month or 10%, but I've seen it at $120 a month. Just like I said before, carriers pull levers like, hey, my cost of insurance is expensive, but I have the best growth. Hey, my cost of insurance is the cheapest there is out there, but my caps are at 7%. So there's always going to be differences in each carrier. And I would say that's the main things to look out for, other than like carrier strength and kind of what they do in the back end. So, Fish, what would you say to look out for besides that?
Yeah, one other interesting thing that you can ask people just to see if they're an actual expert in the industry and what they do, or if they're just an amateur, is, hey, what's this carrier's cap integrity for the last 20 years? Can you show me how the caps and interest rate of in-force policies have changed over the last 20 years because of interest rates and volatility? Most people can't. And the reason that we can is because we started wondering what these policies look like from years and years and years ago, because we wanted to make sure we're putting clients in a good situation. So we've done all that due diligence, called these carriers, asked for reports, where most people don't really even know to do that or know that they can't. So just know that that's one thing you want to make sure of, is ask what the cap integrity is. And that goes back to why we use certain carriers we do, because even when interest rates have changed drastically, the caps haven't moved that much. They do move a little bit, but not a huge amount. And the second thing is also asking about the guarantees on the loans in the policy. Ask if they have a participating loan, or even just ask what type of loans do we have available to access our money in this policy, and what are the guarantees around that. Don't give them any hints about what types of loans that you learned here, but just ask them, what guarantees do I have on the loans, and at what years can I access that with those percentages that you're looking for. So I think that would be some hugely helpful topics for you guys to go through. Again, just make sure you're getting with the right agent, because getting a life insurance policy is a lot like a marriage, where you should hope to only do it once. And if you do it wrong the first time, you're going to find out that it's very costly and very hard to unwind. It's going to be a lot of heartache. So that's what I would just tell you, is make sure you do it the right way. And if you want to do it the right way, hit us up. We'd obviously love to help you make sure that you are utilizing these properly. And if you're not a good fit, guess what? We will also tell you that. And we've turned away
For sure. I can't even tell you, the first year I was in business, I turned down 96% of my clients because they just didn't need it. They wanted it. They could afford it, but they didn't need it. They needed to max out their 401k. That way they could get their tax deferred plus tax-free income. So at the end of the day, we work in all 50 states plus Puerto Rico. So if that's something you're looking for, hit us up.